Okay, we are going to do a cost of goods manufactured like it asked for in question number 3. And we're going to use all those transactions that we did before. So we're going to need them. So, of course, any good report needs a title. So the company's name, what is the name of this report? It's the statement of cost of goods sold. And what's the period? Month ended May 31st. So on your cost of goods sold, you start out with your direct materials. Cost of goods manufactured, I'm sorry. Okay, so our direct materials, we know we used during the month 50,000. All right. And direct labor was 75,000. All right. Then we had our overhead. So we started out with supplies, 8,800. Then that 36,000 was indirect labor. And you can look over here if you want to check me out. I'm just going in order down the overhead control T account. Indirect labor was 36,000. And we had depreciation on the PP&E, which was 10,400. Right. Then we had property taxes on the factory, right? And that was 1450. I guess we didn't get a bill, we accrued that. Utilities on the factory were 5,500. And again, just coming all from here. And then our prepaid insurance. Oh, it's not prepaid, it was an insurance expense, which was 6,200. Oh, and I'm realizing that I left F off. All right, so no, I didn't. Okay, there it is, 6,200. Okay, it was fine. All right, insurance expense, and we did that. So then we're going to add those all up, and our total ends up being 68,350. All right, and we applied more overhead than that, so we need to get that extra overhead in there. Applied overhead, which was 3650. Okay, and now that adds up to 72,000. And that is what we call overhead. Okay, overhead applied. Overhead. This is applied overhead right here, and this is overhead applied 72,000. Okay, now we got to add our direct material, direct labor, and overhead, right, to get our manufacturing costs added. So 50, 75, and 72,000 is 197. All right, and we add in our beginning work in process. So that's what we added during the month. We started out with the work in process of 37,000. And then less ending work in process, right? Beginning inventory plus what you made minus ending. Subtract Ending work in process, 74,000. And that's cost of good manufactured. $160,000. So cost of good manufactured is equal to beginning inventory plus goods manufactured minus ending inventory in terms of work in process. All right, so that's your answer. Question 4 for this problem does ask us, overhead variance is allocated to cost of goods sold. How much is it, and will it increase or decrease? Well, you may recall we already calculated that variance, 3650, over applied. So that means we need to take it out of the cost of goods sold. So we're going to decrease it, right? Because we didn't really have that much expense, so we need to take it out. And you would just credit overhead con, debit cost of goods sold, right? And I'm sorry, reverse that. Debit overhead con, credit cost of goods sold, and you'd be done. All right. Well, good luck.